The Financial Stability Implications of Digital Assets. Number 1034. September 2022. Abstract. The value of assets in the digital ecosystem has grown rapidly amid periods of high volatility. Does the digital financial system create new potential challenges to financial stability? This paper explores this question using the Federal Reserve's framework for analyzing vulnerabilities in the traditional financial system. The digital asset ecosystem has recently proven itself to be highly fragile. However, adverse digital asset market shocks have had limited spillovers to the traditional financial system. Currently, the digital asset ecosystem does not provide significant financial services outside the ecosystem, and it exhibits limited interconnections with the traditional financial system. The paper describes emerging vulnerabilities that could present risks to financial stability in the future if the digital asset ecosystem becomes more systemic, including run risks among large stablecoins, valuation pressures in crypto assets, fragilities of DeFi platforms, growing interconnectedness, and a general lack of regulation. 1. Introduction. The digital asset ecosystem grew rapidly until early 2022, and notwithstanding recent volatility, advocates continue to expect the system to resume its rapid growth. 2. As the digital asset ecosystem grows, becomes more interconnected with the traditional financial system, and mimics products and structures of traditional finance, it creates new potential challenges to financial stability. The digital asset ecosystem replicates many of the same types of market failures and vulnerabilities that arise in traditional finance, generally without regulatory safeguards, while also introducing new risks. This paper describes risks associated with digital assets using the Federal Reserve's framework for analyzing vulnerabilities in the traditional financial system, which distinguishes between vulnerabilities and shocks. Financial vulnerabilities are a collection of factors that may amplify financial shocks. Vulnerabilities tend to build up over time, and policies can be designed to lessen them, making the system more resilient and thus more likely to be able to continue to function effectively in the face of shocks. For our analysis, we define the digital asset ecosystem as including coins designed to maintain a stable value, crypto assets without such a peg, centralized lenders and exchanges, and decentralized finance, DeFi, protocols, among other things. Activities within the ecosystem involve liquidity and maturity transformation without access to a liquidity backstop, which exposes the system to the possibility that investors will run to withdraw funds quickly in adverse situations, possibly inducing fire sales of assets to meet those redemptions. Taking leveraged positions to speculate on changes in the price of digital assets is common. Few limits exist on leverage or collateral rehypothecation. Leverage increases the risk that actors in the digital asset ecosystem will not have the ability to absorb even modest losses when hit by adverse shocks and will be forced to cut back lending, sell assets, or even shut down. Crypto valuations have risen and fallen rapidly, are in many cases volatile relative to valuations of traditional assets, and have, at times, exhibited high correlations with valuations in traditional financial assets. 3. These strong correlations and rapid fluctuations in asset values create vulnerabilities when combined with leverage and liquidity transformation practices of lending platforms, DeFi protocols, and centralized exchanges. Several features of the digital asset ecosystem introduce novel vulnerabilities to its stability. Where transaction execution is automated, it reduces the response time for interventions that could prevent fire sales or other destabilizations. 4. At the same time, decentralized governance of certain platforms can hinder rapid action to mitigate stress or create regulatory challenges. Automation may also exacerbate operational vulnerabilities. Public blockchains, crypto assets, stablecoin issuers, DeFi protocols, and centralized exchanges are interconnected, with no limits on concentrated exposures. Shocks in one area can spill over quickly to others. Digital assets' interlinkages with the traditional financial system are limited at present but may grow, increasing the potential for spillovers to the traditional financial system. The lack of a strong and cohesive regulatory framework for digital assets amplifies these vulnerabilities. Many parts of the digital asset ecosystem are designed to avoid regulation. Digital assets do not fit neatly into existing regulatory frameworks. In addition, controlling influence is often obscured, for example, in DeFi, or dispersed, for example, blockchain validators. 5. When digital asset companies are registered as legal entities, They are often domiciled in non-G20 countries. Establishing regulation for the digital asset space would be further complicated by novel activities and arrangements operating without legal entities, such as decentralized autonomous organizations, DAOs, and smart contracts. The digital asset ecosystem has recently proven itself highly fragile. In the context of a changing macroeconomic environment, high-profile projects have failed, and key institutions have found themselves facing liquidity issues and insolvency. However, these adverse shocks have not created negative feedback loops in the traditional financial system, as the digital asset ecosystem does not provide significant financial services outside the ecosystem and its interconnections with the traditional financial system are limited. However, we identify emerging vulnerabilities that could present risks to financial stability in the presence of stronger interlinkages between digital and traditional financial institutions and in the event of future growth of the digital asset ecosystem. Run risk in stablecoins, where issuers may dispose of reserve assets quickly to meet redemptions, potentially disrupting traditional financial markets. Valuation pressures and risk appetite in crypto asset markets. Fragilities of decentralized and centralized platforms, including leverage and maturity and liquidity transformation, and novel risks such as greater automaticity in DeFi, and interconnectedness across these vulnerabilities and a general lack of regulation in the ecosystem. Section 2 provides an introduction to the components of the digital asset ecosystem. The sections following describe financial stability vulnerabilities associated with stablecoins. Section 3, Crypto assets. Section 4, DeFi. Section 5, Lending platforms. Section 6, Centralized exchanges. Section 7, and Interconnectedness. Section 8. Section 9 discusses regulatory gaps. Section 10 concludes with our assessment of the financial stability implications of digital assets. A case study of the Terra USD collapse in May 2022 and its repercussions in digital and traditional markets is described in Box 1. 2. A quick review of the digital asset ecosystem. Digital assets operate as part of a complex and interconnected digital ecosystem, as shown in Figure 1. The foundation of the ecosystem is the blockchain, a type of distributed ledger where transactions are recorded and participants transact with other participants and decentralized applications. Bitcoin and Ethereum are the two largest blockchain networks. Bitcoin was the first blockchain, designed as the ledger for a payment system but lacking full programmability. Ethereum introduced the concept of a programmable blockchain with smart contracts, which are essential to DeFi, discussed later. Crypto assets are created and transferred on a blockchain, and most blockchains have a native crypto asset. Bitcoin and Ether, the native assets of the Bitcoin and Ethereum blockchains, respectively, are the crypto assets with the highest market capitalization. These top native crypto assets have garnered attention and large market capitalizations and have experienced extreme volatility. Ether and Bitcoin, or wrapped synthetic Bitcoin, are commonly used as collateral in digital financial transactions. Figure 1. The digital asset ecosystem. Stablecoins, SCs, intend to provide a stable value reference asset within the digital asset ecosystem to facilitate trading, lending, or borrowing of crypto assets while allowing users to avoid moving in and out of fiat. Stablecoins are essential to transacting across crypto assets in DeFi. Importantly, stablecoins of this type, which are common in the digital ecosystem, are not used to facilitate wholesale or retail payments across the real economy. Stablecoins are not widely used as a means of payment at present. DeFi facilitates the automation of financial activities such as lending, savings, payments, and trading through smart contract code, purportedly eliminating the need for financial intermediaries and centralized institutions. The most prevalent use cases in DeFi are trading and lending. In the trading space, popular decentralized exchanges such as Curve and Uniswap offer users the opportunity to exchange one asset for another without the involvement of a third party, quoting traders an algorithmically determined asset price. In the lending space, depositors receive yield on digital assets, and pseudonymous borrowers take over-collateralized digital asset loans from protocols like Aave and Compound. Applications provide convenient interfaces for accessing assets and smart contracts. Centralized crypto exchanges serve as the primary means of converting fiat currency to crypto assets and otherwise provide a range of services akin to those provided by traditional financial intermediaries. Most crypto asset trading volume involves centralized exchanges, which holds central limit order books off the blockchain. Digital wallets allow users to hold and interact with their digital assets. 3. Stablecoins. Stablecoins are digital assets that aim to maintain a stable value relative to a reference asset, typically the US dollar. Currently there exist different stablecoin designs, as we describe in the next subsection. The least stable designs have already experienced destabilizing runs, like the collapse of Terra USD in May 2022, see Box 1. But even the less fragile designs of larger stablecoins appear subject to runs. If a sizable share of holders rushed to sell or redeem a large stablecoin like Tether, USDT, or US dollar coin, USDC, it could not only create instability in the digital asset ecosystem, but also disrupt certain markets in the traditional financial system, as stablecoin issuers would have to dispose of their reserve assets quickly to meet redemptions. These disruptions would likely be more severe in the case of stablecoins with less liquid reserve assets, like corporate bonds and commercial paper. Moreover, stablecoins underpin the crypto ecosystem, and their demise could cause spillovers within that ecosystem, amplified by vulnerabilities from leverage, liquidity transformation, and interconnectedness in the crypto financial system. Nonetheless, financial stability risks from stablecoins and the amplification mechanisms of such risks through vulnerabilities in the crypto ecosystem are hard to gauge, as information is poor and regulation and supervision are weak. 3.1 Overview. Stablecoins experienced rapid growth in 2020 and 2021, with the 5 major stablecoins growing more than fourfold in both years, Figure 2. By contrast, year-to-date as of July 31st, the market capitalization of the same 5 stablecoins has been flat, reflecting the collapse of Terra USD and the associated decline of other stablecoins that wiped out the growth in the first 4 months of the year. As shown in Figure 2, the largest stablecoin is Tether, with a market capitalization of $67 billion, down 20% from its peak of $83 billion. The second largest stablecoin is USDC, with a market capitalization of $54 billion. They are followed by Binance USD, BUSD, and DAI, with market capitalizations of $18 billion and $7 billion, respectively. The fifth stablecoin presented in Figure 2 is Terra USD, USD, which experienced a run that reduced its market capitalization from a peak of more than $18 billion at the end of April to $346 million at the end of July. See Box 1. The recent growth of stablecoins has coincided with broader growth of the crypto asset markets and DeFi. Within the crypto ecosystem, stablecoins primarily exist to facilitate trade and to enhance the transferability of funds across blockchains. These properties are desirable as a medium of exchange in the crypto ecosystem, especially given the relatively large fees involved in going from crypto assets into traditional assets. Moreover, stablecoins are the assets most commonly deposited and borrowed in DeFi, most quoted in decentralized exchanges, and most touted as earning yields in excess of bank deposits. DeFi applications essentially operate using stablecoins. Proponents of stablecoins argue for their potential to become a widely used medium of exchange within and outside the digital ecosystem. To achieve widespread use, they must be readily transferable with a reliable and accurate mechanism for transferring ownership, as highlighted in the presidential working. Figure 2. Market cap of major stablecoins. Group Report. 6. Outside of the crypto ecosystem, stablecoins might grow to become a medium of exchange available to the general public, thus spurring more competition in the traditional payment landscape. Whether such competition will translate into a welfare gain is still an open question. 7. For the banked population, the development of a retail real-time payment system, such as FedNow, might achieve the goals that a stablecoin could achieve. 8. The unbanked population could benefit from using stablecoins. Whether the unbanked can realize these benefits depends on digital wallets becoming accessible without relying on bank accounts and traditional payment systems. In addition, stablecoins that are quoted in different currencies might lower the costs of cross-border payments for both retail and wholesale transactions. Whether the technology underpinning stablecoin transfers can realize such gains depends on how much it can save on the costs of the current correspondent banking system and continuous linked settlement, CLS. 9. Detractors of stablecoins highlight their fragility, as exemplified by the recent collapse of Terra USD and the previous failure of other stablecoins like Iron in June 2021. 10 Weekly regulated stablecoins may be subject to runs and generate negative spillovers across the digital ecosystem and traditional money markets. However, to date, stablecoins' use remains largely confined within the crypto ecosystem. An additional consideration introduced by the wide use of stablecoins may be that bank credit provision would be reduced without a corresponding increase in credit provision through DeFi. The extent to which the wide use of stablecoins could reduce aggregate credit provision will depend to a large degree on how stablecoins manage their reserves. If, for instance, stablecoin reserves are used to fund banks through deposits or other money market instruments, credit provision would be less affected. 3.2. Run risk. Liquidity and maturity transformation. Stablecoins are marketed as being stable and pegged to their reference asset, creating the perception that users can redeem them on demand for the reference asset. Yet, in practice, most stablecoin issuers impose redemption restrictions or even reserve the right to withhold redemptions, leaving users that want to liquidate their stablecoins with only the option to trade them in secondary markets. The perception that stablecoins can be redeemed on demand is enough for them to create vulnerabilities from liquidity and maturity transformation, as stablecoin reserve assets could be illiquid or have longer maturities. Different stablecoin have different designs aimed at maintaining their peg, which can affect their susceptibility to runs. Stablecoin can be partitioned according to two key distinguishing features, as shown in Figure 3. Their degree of collateralization, shown on the vertical axis, and their degree of centralization, shown along the horizontal axis. Figure 3. Stablecoins' key design features. The first key design dimension is the degree of collateralization, the vertical axis. Given the lack of standardization or regulation, stablecoin issuers have been able to use assets of different quality to back stablecoins. At one extreme, stablecoins fully backed by central bank reserves are resilient to runs. But holding central bank reserves requires an account at the central bank, which is generally limited to regulated depository institutions. At the other extreme, there are stablecoins that are backed by low-quality collateral or by no collateral at all, as represented by the vertical axis in Figure 3. Among decentralized stablecoins, DAI is an algorithmic stablecoin designed to be over-collateralized, while Terra, or Terra USD for its dollar stablecoin, is an algorithmic stablecoin that was designed with no collateral. 11. Among centralized stablecoins, USDC is collateralized by higher-grade assets than Tether, based on self-disclosures. In fact, shortly after the Terra USD collapse, Tether saw redemptions of around $10 billion, while USDC saw a little more than $4 billion of new inflows, Figure 2. This substitution from Tether into USDC illustrates a bigger concern, namely, that resilient stablecoins can amplify run risks from more fragile ones, as they provide a convenient instrument to run to. The second key design dimension is their degree of centralization of governance. Some stablecoins, like Tether, USDC, or BUSD, are issued by a single entity with a centralized governance structure. By contrast, DAI and Terra USD have decentralized governance structures and are issued and administered using smart contracts. In this case, issuance and redemptions are carried out by a smart contract that follows preset rules that can be modified by a decentralized autonomous organization, DAO. For example, changes in the collateral eligibility for creating or minting DAI tokens are voted on by the governance token holders. Coordination problems at DAOs, given their governance structure, create higher vulnerabilities from decentralized stablecoins, all else being equal. It is worth emphasizing that triggers for a run on stablecoins can arise from different sources. On the one hand, a drop in the price of the collateral assets, or a lack of trust in the custodian of those assets, could trigger a run. 12. On the other hand, the trigger for a run could be a sudden lack of confidence in the stablecoin, which could be self-fulfilling and might be the result of a speculative or short seller's attack on the stablecoin analogous to those that threaten currency pegs. A run-on in stablecoin can create negative feedback loops via the stablecoin's relationships with DeFi applications and crypto asset prices. Moreover, because stablecoins are supposed to be the safest asset in the crypto ecosystem, problems with them pose the greatest systemic risk within crypto. As the stablecoin loses its peg, DeFi platforms that operate using that stablecoin may become stressed. Users withdraw funds from lending platforms and borrowers see their rates increase rapidly. Stress is transmitted to DeFi exchanges, centralized exchanges, and other cryptocurrencies. In the case of the demise of the Terra platform, the collapse of the Terra USD stablecoin, which had a total market capitalization of about $18 billion by the end of April, was accompanied by a decline of $25 billion of total value locked, TVL, in the Terra blockchain. Associated with its DeFi applications, like Anchor and Mirror, with knock-on effects on Terra investors and their counterparties, see Box 1. In addition, for stablecoin collateralized by traditional financial assets, off-chain, a run could lead to liquidations and fire sales of the collateral assets. At present, Tether, USDT, is reportedly one of the largest commercial paper holders in the world. 13. A fire sale due to liquidations of commercial paper to address redemptions could have significant financial stability implications. 14. 4. Crypto assets. Crypto assets are digital assets that use cryptographic techniques to prove ownership. The crypto assets with the largest market capitalization, like Bitcoin or Ether, are not designed to maintain a stable value. Some have argued that because these assets do not have associated cash flows, their fundamental value ought to be zero. However, in principle, even in the absence of cash flows, investors might be willing to pay for these assets. 15. First, they could expect that other investors will be willing to pay more for the asset in the future, as in a typical asset bubble. One common narrative is that this valuation motive is stronger for Bitcoin given the scarcity created by its cap on total coin supply and long-lived nature. Second, investors might expect that the assets will generate cash flows in the future, in which case they will be willing to pay for the asset depending on their assessments of the likelihood and the size of these payments. And some investors might view future asset repurchases as akin to future cash flows. Finally, investors might hold these assets if they are needed to perform some activities, like settling transactions on the ledger. The main financial vulnerability from crypto assets currently is the buildup of valuation pressures, signaled by prices that are high relative to fundamentals of crypto assets that are typically associated with increased risk appetite. In fact, periods of elevated asset prices accompanied by risk appetite and followed by large declines in asset prices are common in the short history of Bitcoin and other crypto assets. Vulnerabilities from valuations are amplified by interconnections and other vulnerabilities within the crypto ecosystem. In particular, crypto assets are used as collateral in crypto lending and DeFi and represent the bulk of assets traded in centralized and decentralized exchanges, which facilitate the use of leverage, engage in liquidity transformation, and are unregulated and opaque. As the crypto system grows larger and gets more interconnected with the traditional financial system, vulnerabilities from asset valuations could spill over into traditional financial markets. For example, portfolio effects for hedge funds, crypto-related public companies, and private equity could cause spillovers to other assets as exposures of these institutions to crypto markets continue growing. 4.1. Overview. Most blockchains have a native crypto asset used to settle transactions on the network. For example, for transaction fees generated on the Ethereum blockchain, Ether is the only means of payment. Blockchains that allow for richer programming environments are host to a number of non-native crypto assets such as crypto asset tokens, stablecoins, and non-fungible tokens, NFTs. The market capitalization of crypto assets experienced very rapid growth in late 2020 and early 2021, reaching a peak of more than $2.5 trillion for the total market capitalization. This number excludes stablecoins, as shown in Figure 4. As of July 2022, the largest cryptocurrency is Bitcoin, BTC, with a market capitalization of $450 billion, down almost 70% from its peak of $1,274 billion reached in November 2021. The second largest cryptocurrency is Ether, ETH, with a market capitalization of $200 billion. They are followed by BNB, XRP, and Cardano, ADA, with market capitalizations of $47 billion, $38 billion, and $17 billion, respectively. Figure 4. Total market cap of crypto assets. 4.2. Valuation pressures. Valuation pressures in crypto assets are underscored by the recurrent large declines in the price of Bitcoin and other crypto assets, with Bitcoin having fallen about 70% since its peak in November 2021 and having experienced similar declines after its previous peaks in 2017, 2013, and 2011. Without an underlying claim on cash flows, assessing a crypto asset's fundamental value is a challenge. Further complicating this assessment is the high correlation across crypto assets and the elevated price volatility. In addition, the purported value of thinly traded assets may not reflect their current value. 16. Research suggests that most of the variation in the prices of crypto assets are associated with a common factor, with only a small fraction of price movements associated with the idiosyncratic characteristics of individual digital currencies. 17. In fact, Figure 5 shows that since Bitcoin reached its all-time high in November 2021, the prices of major cryptocurrencies have all followed a similar downward trajectory. Over the past few years, the returns on Bitcoin have been strongly correlated with the returns on other cryptocurrencies. High correlation among crypto assets and low explanatory power of valuation measures suggest a large role for risk appetite in driving the prices of these assets. In addition, many retail traders of crypto assets exchange information or trading ideas via social media platforms, such as Reddit and Twitter. Information propagation via social media, especially in crypto markets that are lightly regulated, can contribute to price volatility or even market manipulation by coordinating actors across crypto assets. 18. Figure 5. Performance of major cryptocurrencies since Bitcoin's all-time high. The large price swings of crypto assets are reflected in high realized volatility for this asset class. Figure 6 compares the volatility of crypto with traditional assets. BTC and ETH display volatilities that are higher than most traditional assets in normal periods, defined as periods where neither the traditional nor the crypto markets experience stress. Moreover, during periods of traditional market stress, crypto assets can be as volatile as traditional assets, and during periods of crypto stress, these assets are even more volatile than traditional assets. Figure 6. Volatility of crypto and traditional assets in normal periods. Finally, we compare the correlation of crypto and traditional assets over time. Figure 7 displays the correlation of Bitcoin and the S&P 500 index over moving, rolling windows of 30 and 90 days. The 90-day correlations between these assets started close to zero at the beginning of 2017 but have been much higher lately, displaying higher correlations around the COVID event and in the most recent periods. This pattern is apparent in correlations with other traditional financial assets as well and suggests that crypto assets are highly susceptible to changes in risk sentiment in traditional financial markets. Figure 7. Rolling window correlations. 5. DeFi. Decentralized finance, DeFi, generally refers to open source code running on open access blockchains that aim to provide financial products without traditional financial intermediaries. 19. DeFi facilitates the automation of financial activities through smart contract code. DeFi protocols engage in maturity and liquidity transformation with little or no regulation and without access to a liquidity backstop, offer users leverage to speculate on the value of crypto assets, and include design features that contribute to volatility in crypto asset prices. Volatile crypto assets are used as collateral in DeFi lending and are often rehypothecated in other protocols. DeFi also presents novel risks to financial stability, such as greater automaticity in transactions. While DeFi is also highly interconnected with other aspects of the digital asset ecosystem, its relatively small size and lack of direct connections with traditional financial institutions somewhat mitigate the extent to which DeFi represents a significant financial stability vulnerability in the short run. 5.1. DeFi Overview. DeFi applications experienced explosive growth in 2021. See Figure 8, as venture capital-backed DeFi projects proliferated and attracted users with the promise of outsized returns and the potential to gain exposure to rapidly appreciating crypto assets. This growth drew investment and talent to the space, leading to rapid refinement and evolution of DeFi products and technology. While DeFi aims to create efficiencies and pass them on to users, lowering the cost of transacting, shortening settlement times. Figure 8. Total value locked by category. And encouraging competition among service providers, its benefits remain mostly theoretical. In its current form, DeFi presents risk to users of its platforms and is vulnerable to collapse. 5.2. Maturity and liquidity transformation. DeFi lending protocols allow depositors to pool assets and earn interest generated from the proceeds of loaning those assets to borrowers. In DeFi lending protocols, depositors receive a utility token, representing their share of the liquidity pool, and any accrued interest. Anonymous borrowers generally over-collateralize their loans. 20. Usually, borrowers on DeFi lending protocols pledge crypto assets as collateral in exchange for loans denominated in stablecoins, allowing users to access liquidity without selling crypto assets. 21. Like banks, DeFi lending protocols facilitate maturity transformation. Loans in DeFi lending protocols typically have indefinite terms and floating rates, and borrowers can repay at any time. Depositors can usually withdraw funds at any time, provided there are sufficient assets in the pool. This maturity mismatch creates a risk that lending protocols mitigate by varying interest rates, on loans and on deposits, to attract deposits and incentivize loan repayment when liquidity is low. 22. When users respond to those incentives, run risks can be mitigated or managed by the software protocol. Users of DeFi lending protocols are exposed to liquidity risk. If a particular crypto asset has been fully loaned out, no depositor may withdraw that crypto asset from the protocol, and no borrowers can take loans in that crypto asset, until existing loans are repaid or new deposits are added to the pool. If depositing is unattractive and borrowers are unable or unwilling to repay their loans, depositors would be reliant on liquidation of collateral for depositors to recover their assets. See Section 5.4. 23. As with open-ended mutual fund redemptions, these dynamics could create run risk. 5.3. Leverage. The relative ease with which users can obtain leverage on DeFi platforms contributes to vulnerabilities within the broader crypto ecosystem. A relatively simple way to obtain leverage in DeFi involves a user posting collateral using a crypto asset, like Ether, in a DeFi lending platform, like Maker, to obtain a loan denominated in a stablecoin, like DAI. Borrowers often use these loans to buy crypto assets while retaining exposure to the underlying collateral, increasing overall exposure to more volatile crypto assets, and building up wrong-way risk. Crypto assets purchased with borrowed funds may be posted as collateral for another stablecoin loan, creating leverage. Excessive leverage increases the risk that actors in the system will not have the ability to absorb even modest losses when hit by adverse shocks. Collateral rehypothecation. Rather than loan collateral remaining with a protocol until the loan is repaid or liquidated, the platform can, and many do, rehypothecate the collateral on a different platform, either as collateral for an additional loan or as liquidity in a liquidity pool, or stake the collateral to earn rewards, like Terra's Anchor protocol. The ability to generate leverage and yield through rehypothecation is limited only by the crypto assets that different DeFi protocols accept. As in the traditional financial system, rehypothecation creates a collateral chain and introduces additional vulnerabilities, as liquidation of the underlying collateral in any protocol could cause a cascading pattern of selling as users unwind positions across different platforms. Borrowing against depository receipts. Certain DeFi protocols accept digital depository receipts from other protocols as collateral for loans. For example, users may receive tokens for providing liquidity to decentralized exchanges, DEXs. These liquidity provider tokens from decentralized exchanges can be used as collateral in lending protocols, and borrowed value from lending protocols can then be redeposited elsewhere. Similarly, depository receipts from lending protocols can be exchanged for crypto assets in a decentralized exchange. While depositors' assets may be lent to a borrower, a representation of those funds supports other financial activity in the DeFi ecosystem. Again, loan liquidations could result in a cascading pattern of withdrawals and users removing liquidity. 5.4. Valuations and Volatility. Several aspects of DeFi arrangements may contribute to volatility in crypto asset valuations. Liquidation mechanisms. On a lending platform, if a borrower's collateral value falls below a required threshold, a third party may buy out the position, liquidating it by repaying the loan and seizing equivalent collateral plus a liquidation bonus. 24. These liquidations can have a persistent effect on crypto asset prices, leading to further liquidations. 25. Sophisticated actors often use code to look for under-collateralized loans to liquidate or monitor the mempool of pending transactions to front-run or force liquidations by creating artificial price volatility. 26. These dynamics can result in unexpected losses to less sophisticated users, and technical uncertainty and panic could exacerbate periods of stress. Blockchain congestion. The smooth operation of DeFi relies on blockchains to process transactions promptly. During periods of high trading volumes, limits on blockchain processing speeds can result in delays in transactions processing, front-running by blockchain validators, and outsized price moves. Congestion on blockchains can result in additional liquidations, as borrowers seeking to recollateralize their positions may be delayed. Bridges. Greater interoperability through bridges, which allow tokens designed to be used on one blockchain to be deployed on another, expands access to new protocols and assets. 27. But can also become a transmission channel for stress. For example, users might address a loss of liquidity on one blockchain by transferring funds from another, leading to cascading contagion over multiple networks. Bridges have also proved a key source of technical weakness as the targets of many successful cyberattacks. 5.5. Novel risks. Automaticity without circuit breakers. Smart contracts, a key feature of DeFi, automatically execute transactions according to pre-specified conditions. By design, the code governing smart contracts cannot be amended, transactions cannot be paused, and parties to the smart contract have no recourse in case of an error or exploit. Reliance on smart contracts heightens the risk of contagion in the DeFi ecosystem. Where transaction execution is automated, the response time for interventions that could prevent fire sales is compressed. The absence of circuit breakers and price bands heighten the risk of a flash crash. 28. Oracle risk. DeFi protocols require price information for the different varieties of collateral they accept, for example, to determine when a loan is undercollateralized. Oracles are the channel through which a protocol accesses off-chain data or data from other chains. When oracles are manipulated, smart contracts act on false information, which can lead to cascading liquidations. For example, if an oracle reflects inaccurate high asset prices and positions are assessed as undercollateralized as a result. Decentralized decision-making. The extent to which governance of DeFi protocols is decentralized is often unclear and varies across protocols. Decentralized decision-making may preclude rapid action to mitigate stress, as has been demonstrated by events in the digital ecosystem. Flash loans. A flash loan requires no collateral and offers loans with no amount limits as long as the loan is borrowed and repaid within a single transaction. The transaction is automatically cancelled if the borrower cannot repay the loan before the transaction ends. Flash loans are available in numerous DeFi protocols and were originally developed to facilitate arbitrage but are often used to engage in DeFi hacks and exploits, using loaned assets to change protocol governance or drain a protocol of funds. 6. Lending platforms. 6.1. Overview. Crypto lending platforms engage in maturity transformation, attracting crypto asset deposits from retail customers with high interest rates and using those funds to make loans. In contrast to DeFi lenders, lending platforms extend collateralized crypto asset loans to retail customers and uncollateralized or partially collateralized loans to crypto-native institutions, and borrowers are generally known, not pseudonymous. Notable operating lending platforms include BlockFi, Nexo, CoinLoan, and, until July 2022, Celsius and Voyager. Platforms' risky bank-like activities, conducted without deposit insurance, access to a government backstop, or prudential requirements that strengthen loss-absorbing capacity, heighten the risk of fire sales and contagion in the ecosystem. 6.2. Vulnerabilities. Of the entities in the crypto asset ecosystem discussed in this paper, lending platforms are structured most like banks. They suggest that depositors will be able to access the assets in their account on demand and provide credit based on an assessment of borrower quality or collateral value. Unlike banks, however, lending platforms are not subject to prudential supervision and regulation, which ensure adequate resources and strong risk management practices necessary to support their businesses under stress. Lending platforms are not subject to capital or risk management requirements or prudential supervision of their safety and soundness. As such, platforms may maintain little to no loss-absorbing capacity. For example, Celsius, a lending platform, disclosed that it had a 0.1% capital ratio before stress forced it to freeze withdrawals and then declare bankruptcy. Without concentration limits, lending platforms may extend large loans to a small number of borrowers, increasing their risk of insolvency in the event of a counterparty default. Thinly capitalized platforms with concentrated exposures may be vulnerable if even one borrower defaults. For example, Voyager Digital made loans to one counterparty, 3 Arrows Capital, or 3AC, representing 58% of its loan book and more than twice its total capital. 3AC's default eventually contributed to Voyager suspending withdrawals and securing an emergency line of credit, but Voyager ultimately could not remain solvent and declared bankruptcy. Engaging in risky bank-like activities without liquidity requirements, access to a government backstop, or deposit insurance creates the potential for a run when depositors are exposed to potential losses. As depositors rush to withdraw funds, lending platforms may be forced to sell assets at distressed prices to meet redemptions. These fire sale dynamics can also create contagion, affecting similarly positioned market participants. Lending platforms do not only use customer assets to make under-collateralized loans. Celsius bankruptcy filing, for example, states that the platform was permitted to use the assets in its sole discretion, including rehypothecating those assets, for example, using those assets as collateral to take out additional loans to generate yield. 29. When lending platforms use depositors' assets to build leveraged positions, they increase the fragility of the crypto ecosystem. Concentrated leverage could put pressure on the price of crypto assets, as occurred with staked Ether, staked ETH. 30. As ETH liquidity dried up following the Terra collapse, staked ETH began to trade at a significant discount to Ether, creating liquidation pressures for users that had built leveraged positions in staked ETH. Greater leverage reduces the potential that platforms can withstand even a small shift in asset prices and heightens the risk that they will face liquidity or solvency crises. Beyond these risks to the ecosystem, lending platforms also contribute to leverage by allowing their users to borrow funds to grow their positions in a certain asset. Margin loans from lending platforms may encourage moderate additional leverage in the system. 7. Centralized crypto exchanges. The multiple roles centralized crypto exchanges, CEXs, play in the digital asset ecosystem are opaque, largely unregulated, and highly interconnected. In contrast to DeFi exchange platforms, DEXs, which operate on blockchains, centralized exchanges hold central limit order books and operate off-chain. Users generally exchange fiat for crypto assets using CEXs, making them the key on and off ramps between fiat and digital assets. Yet CEXs go well beyond activities of traditional exchanges within the digital asset ecosystem. Without meaningful oversight or regulatory constraints, CEXs provide a link to traditional markets while also creating deep interconnections and new vulnerabilities in crypto asset markets. 7.1. Overview. CEXs facilitate the bulk of retail and institutional investor access to crypto assets, often driving rapid changes in crypto asset prices upon listing or delisting. 31. CEXs also offer a range of services including trading execution, custody, margin lending, prime brokerage, for institutions, and writing and listing crypto derivatives. This paper focuses on Binance, FTX, and Coinbase to illustrate issues with interconnectedness and leverage. These exchanges have daily trading volumes of $12 billion, $2.1 billion, and $1.6 billion, respectively, Figure 9. 32. Figure 9. Trading volume for selected exchanges. 7.2. Interconnectedness. The importance of centralized exchanges, coupled with their related but often obfuscated engagements, intensifies interconnections within and outside of the digital ecosystem. For example, some CEXs operate venture capital funds that develop crypto projects and invest in crypto assets, hold ownership interest in major blockchains or stablecoins, engage in proprietary trading, lending, or selling crypto assets to other exchanges and platforms, and operate media organizations. Binance, in addition to being the largest crypto asset exchange, issues a major stablecoin and crypto asset, developed a major blockchain, and has invested in other third-party crypto projects, including the failed Terra USD stablecoin, via its venture capital entity, Binance Labs. Through Binance Labs, Binance has acquired the data aggregator CoinMarketCap and holds minority stakes in rivals CEX FTX as well as the news agency Forbes. 33. Coinbase, via its venture capital subsidiary, Coinbase Ventures, also owns a stake in FTX and is a founding member of the consortium that develops stablecoin standards, including for USDC, which is currently the second largest stablecoin by market capitalization. 34. Sam Bankman-Fried, FTX's owner, owns Alameda Research, a trading firm that trades on FTX, and founded Decentralized Exchange Serum. FTX bought a U.S. broker-dealer in 2021, and Sam Bankman-Fried acquired a stake in Robinhood. 35. Tether has an affiliated trading exchange, Bitfinex, and there have been reports of close ties to other exchanges and traders. 36. 7.3. Leverage. CEXs provide leverage in the crypto ecosystem through their facilitation of margin lending and offering of leveraged tokens, a type of derivative product that gives consumers leveraged exposure to the underlying asset. 37. CEXs offer derivatives and often allow leverage exceeding 100x. However, the extent of the leverage these exchanges allow in the digital asset ecosystem is opaque, given their off-chain operating model and a lack of oversight and financial disclosures. Similarly, it is not clear how much capital the CEXs hold or how large their trading portfolios and private equity investments are. For example, Binance reportedly took $1.6 billion in losses on Terra, but it is unclear if the losses were due to proprietary trading or holding inventory for market making. 38. 8. Interconnectedness with the traditional financial sector. Shocks to digital assets can propagate due to interconnections within the digital ecosystem, as already highlighted. However, the implications of stress in the crypto ecosystem on financial stability depend crucially on how interconnected it is with the traditional financial sector. In this section we outline many ways in which the digital asset ecosystem and traditional financial system are related. Traditional brokerage firms. An emerging interconnection between crypto markets and the financial system comes from brokerage firms incorporating access to crypto markets into their product offerings. There are several retail brokerages, including Fidelity and Robinhood, that are beginning to offer access to crypto markets. For example, Fidelity plans to allow Bitcoin holdings in 401k retirement accounts. 39. Traditional exchanges. Traditional exchanges have begun to list financial products tied to crypto assets. For example, the CME offers both Bitcoin and Ethereum futures. 40. Canadian and Australian regulators have approved Bitcoin ETFs that trade on exchanges in those countries. In addition, certain crypto exchanges, such as FTX, have begun offering access to financial asset markets via tokenized stocks. 41. Banks. Banks are exposed to crypto assets through multiple channels. First, banks may hold deposits from companies offering stablecoins. For example, the assets of the largest US-based stablecoin USDC are held across multiple banks. Small banks may be more susceptible to liquidity issues in the event of a run on a stablecoin. In addition, several banks hold private equity investments in crypto asset-related companies on their balance sheets. 42. Standard Chartered, BNY Mellon, Citi, and UBS have each invested more than $250 million in crypto asset companies. One firm estimates that the ratio of crypto investment to Tier 1 capital could be as high as 1.5%, though these estimates are unverified. 43. Furthermore, banks and other traditional financial institutions are interacting with platforms and protocols to obtain financing. This adoption may increase interconnections with digital assets. For example, Maker has proposed to tokenize real-world assets and issue loans using these tokens as collateral. 44. Societe Generale has obtained a $20 million stablecoin loan using a tokenized bond. 45. JP Morgan has expressed interest in tokenizing U.S. Treasuries and shares of money market funds to use as collateral in DeFi, which could become a transmission channel for stress from crypto asset markets to the U.S. Treasury market. 46. Venture capital funds. Venture capital firms invested $9.2 billion in crypto asset-related firms in Q1 2022. 47. The limited partners in these venture capital funds are usually pension funds, university endowments, nonprofit foundations, and finance companies. Hedge funds. Many mainstream hedge funds are launching dedicated crypto divisions. 48. Centralized crypto exchange firm Coinbase has stated that institutional investors, presumably hedge funds, traded $1.14 trillion worth of crypto assets in 2021. Public and private companies. A growing number of publicly traded companies have crypto assets on their balance sheets. Because shares in these companies are held by retail and institutional investors, sudden shocks to crypto asset prices may affect the balance sheets of traditional financial institutions. The largest publicly traded company with significant exposure to crypto assets is Coinbase, which was publicly listed in 2021. As of Q1 2022, Coinbase holds more than $200 billion worth of crypto assets for its custodial, brokerage, and market-making services. 49. Besides Coinbase, public companies such as MicroStrategy have significant holdings of crypto assets on their balance sheets. MicroStrategy has almost $4 billion worth of Bitcoin holdings, about $205 million of which were purchased with a Bitcoin collateralized loan. Tesla and Square also hold Bitcoin, though Tesla announced on July 20 that it sold 75% of the Bitcoin it had purchased, adding $936 million to its balance sheet. 50. Private companies, while creating a smaller risk to the financial system, have exposed retail investors to risk. For example, Stablecoin and Celsius have acted as feeder funds to the Terra ecosystem, leading to large losses among some retail investors. 51. Box 1. The Terra Collapse, a case study in interconnectedness. 52. Terra USD was an algorithmic stablecoin designed to maintain a one-to-one peg to the US dollar despite not maintaining a reserve of assets to back issued coins. In early May, Terra USD was the third largest stablecoin, with a total market value equivalent to $18 billion. While Terra USD was able to be used on more than 100 DeFi platforms on the Terra blockchain, most of the activity on the Terra network was on a single DeFi peer-to-peer lending application, Anchor, which offered deposit yields of close to 20%. To maintain its peg, Terra USD used an arbitrage relationship with Terra's native crypto asset, Luna. Luna is an unbacked crypto asset with a free-floating market value and at its peak in April 2022 was trading for over $116, with a total market value of around $40 billion. Terra USD's market value, Luna's price, and the total value locked, TVL, on Anchor grew rapidly from early 2021 through May 2022. However, the entire Terra ecosystem collapsed in less than a week. On May 8 and 9, Terra USD liquidity dried up across multiple DeFi protocols and crypto exchanges, causing the price of Terra USD to decline below 70 cents. In response, there was a rush to redeem Terra USD in exchange for newly issued Luna, driving the price of both down rapidly, resulting in a loss of about $60 billion of value that week, as seen in figures 10 and 11. Terra's collapse contributed to stress throughout the crypto ecosystem. In the immediate aftermath, Tether briefly traded for as low as 94 cents before returning to $1. Crypto hedge fund 3 Arrows Capital, 3AC, which at its peak reportedly had over $18 billion in assets under management, 53, was heavily invested in Terra, Luna, 54, and has been ordered to begin liquidations and has filed for bankruptcy under Chapter 1555. Voyager Digital, a publicly traded crypto exchange and lender with about $6 billion in assets and about $250 million in total equity as of March 31, claims that 3AC defaulted on a loan worth about $660 million. 56. Similarly, Celsius, another crypto lender that invested in Terra, has filed for Chapter 11 bankruptcy protection. 57. 58. In other interconnections, Terra's founder reportedly sold $2.4 billion worth of Bitcoin trying to maintain Terra USD's peg before its eventual collapse. 59. Additionally, Terra users rapidly withdrew crypto assets from the Terra blockchain, particularly staked Ether used as loan collateral on the Anchor protocol. These events led to direct pressure on the prices of major crypto assets. The rapid decline in crypto asset prices, for example, Bitcoin's price declined by about 60% between April and June, has led to margin calls, sell-offs, and liquidations. While Terra's collapse has had a limited effect on traditional financial markets, it illustrates the fragility and interconnectedness of the crypto ecosystem. 9. Regulatory challenges. Digital assets do not fit neatly into the U.S. regulatory framework, and opacity, extraterritoriality, and new legal structures create further challenges. Limited or no regulation of key entities contribute to fragilities in the digital asset ecosystem. 9.1. Risk from outside the regulatory perimeter. Oversight, comprehensive disclosures, and capital and liquidity requirements, where appropriate, could improve the resilience of entities within the digital asset ecosystem. For example, Centralized crypto entities that act as counterparties to retail users in the digital asset ecosystem are generally not subject to capital, liquidity, or comprehensive disclosure requirements. Where a platform's counterparty risk, leverage, and loss-absorbing capacity are unclear, the exchange's users could be incentivized to withdraw assets at the first sign of stress. In the traditional financial system, activities like maturity and liquidity transformation and margin financing are housed within financial institutions subject to oversight and regulatory requirements. Stablecoins, in particular those collateralized by off-chain assets, engage in the same type of maturity and liquidity transformation as banks or money market funds but without the same safeguards or regulations. The Executive Order on Ensuring Responsible Development of Digital Assets has directed the U.S. regulatory agencies to further explore the issue, stating that the United States should ensure that safeguards are in place and promote the responsible development of digital assets to protect consumers, investors, and businesses. 60. Lawmakers may in the future see fit to expand the regulatory perimeter to include digital assets. This objective may be complicated by resistance to regulation by some in the digital asset ecosystem. Attempts at building sanctions-compliant crypto products have prompted backlash from parts of the crypto community, and migration to less compliant products. 61. While in most cases some entity has control or at least significant influence over a blockchain, asset, or protocol, it is often challenging to identify who has responsibility for addressing risks to users. Where crypto companies exist as legal entities, they are often domiciled in jurisdictions with a focus on privacy over transparency. Bringing entities in the digital asset ecosystem within the U.S. regulatory perimeter could require identifying their linkages with organizations that are under the purview of U.S. regulators or indirectly targeting their activities. These linkages could be difficult to establish. For example, virtual private networks, or VPNs, can mask a user's location, making it difficult to establish a U.S. nexus even when counterparties are physically located in the United States. Given the high degree of interconnectedness in the digital asset ecosystem, interagency coordination and information sharing is crucial, domestically and internationally. 9.2. Regulatory scope and novel digital assets. Another challenge in expanding the regulatory perimeter relates to novel technologies and arrangements that make even indirect regulation challenging. Smart contracts, for example, function as counterparties and intermediaries and interact with digital asset wallets and other smart contracts, yet they are stored and executed as pieces of code. Revisions to smart contracts may not be possible, even if required by statute, rule, or supervisor, because they cannot be amended once in place. As another example, control of DeFi protocols is purportedly exercised through decentralized autonomous organizations, DAOs. Though legal entities associated with the DAO and protocol often exist, they often act at the direction of the DAO and may be unable to exercise agency. Subjecting these types of entities to regulation and enforcing such regulations may be challenging. 9.3. Related stablecoin efforts. Several existing stablecoin issuers and entities with stablecoin projects under development have stated ambitions for the stablecoin they create to be used widely by retail users to pay for goods and services, by corporations in the context of supply chain payments, and in the context of international remittances. Payment stablecoins face many of the same basic risks as traditional payment systems, including credit risk, liquidity risk, operational risk, risks arising from improper or ineffective system governance, and settlement risk. In order to address such risks, the President's Working Group on Financial Markets, the Federal Deposit Insurance Corporation, and the Office of the Comptroller of the Currency issued a report with the following key recommendations. 62. To address risks to stablecoin users and guard against stablecoin runs, legislation should require stablecoin issuers to be insured depository institutions. To address concerns about payment system risk, legislation should require custodial wallet providers to be subject to appropriate federal oversight. Congress should also provide the federal supervisor of an stablecoin issuer with the authority to require any entity that performs activities that are critical to the functioning of the stablecoin arrangement to meet appropriate risk management standards. To address additional concerns about systemic risk and concentration of economic power, legislation should require stablecoin issuers to comply with activity restrictions that limit affiliation with commercial entities. Supervisors should have authority to implement standards to promote interoperability among stablecoins. In addition, Congress may wish to consider other standards for custodial wallet providers, such as limits on affiliations with commercial entities or on use of users' transaction data. Congress is considering proposals related to stablecoin issuance. 10. Conclusion. The digital asset ecosystem is prone to the buildup of financial vulnerabilities. This propensity reflects both the lack of a strong supervisory and regulatory framework for financial activities in the digital space and novel risks associated with new technologies that exacerbate these vulnerabilities. 63. Currently, financial stability risks are not extensive because the digital asset ecosystem does not provide significant financial services and its interconnections with the traditional financial system are limited. At present, the potential spillovers from runs on stablecoins that are backed by money market instruments represent the most salient financial stability risk. Should the digital financial system become more interconnected with the traditional system or expand its provision of financial services, financial stability risks could quickly become material.